Good morning, everybody. Hope you had a lovely Easter, and welcome to our next webinar, Tax Returns Done Right, Key Insights for Accuracy and Compliance with Olivia Pryor. We will be taking questions if you want to pop them in the Q&A box, and then if we have time at the end, we'll go through the questions. If we do happen to run out of time, don't panic. We'll download the questions and we will answer them via email. Thank you very much. Over to you, Olivia.
Hi, everybody. Thank you, Sarah. Hi, everyone. My name is Olivia. I'm an assistant tax manager at ETC Tax, who are a specialist tax advisory firm based in Cheshire. So a little bit about me, my role at ETC is to help advise high net worth individuals and owner managed businesses on a variety of tax affairs. So just before we go into the webinar, I'll just talk a bit about that. As a firm, we cover a broad spectrum of areas that can range from private client taxation matters such as inheritance tax planning, residency matters, more corporate matters such as business reorganisations, that sort of thing. Ultimately, we work with clients to provide holistic advisory services and work to make that process as simple as possible for them. But as an extension to our advisory offering, we do also do tax compliance services, which includes the preparation of tax returns. So that's either on an annual or ad hoc basis when the need arises. We also work with professional advisors such as accountants and IFAs, just to provide a full service offering to their clients and ultimately help them to enhance their practices too. So our tax compliance function mainly looks at the more complex cases, which maybe the average high street accountant might not come across all the time. But that doesn't mean we don't deal with the more simpler cases as well. So ultimately, we are here today to discuss some insights into ensuring a return is accurate. And hopefully you can take away some tools which can help you going forwards to identify where maybe matters can get a bit more complex and prepare you for tackling those matters when they arise. So some of the content I'll cover might come as common sense to some people. So I still think it's worth going back to basics a little bit, cover those fundamentals, and then hopefully we can build on that and discuss where cases in further detail can get a bit more complex and you can find some value in that. Next slide, there we go. So just a quick overview of the session. So I'm just going to cover the main areas I want to focus on, which will include the importance of getting your tax return right, specifically where attention to detail can be quite a huge difference between right and wrong, the value in fact-finding prior to engagement, and some pitfalls where preparers might miss key aspects of certain tax returns. I'm going to go through some live examples of complex cases we have come across at ETC, just to provide an insight as to what appears might be a simple case at the beginning can turn into quite a more complex matter just by asking a few more questions. I'll talk about our view on white space disclosures and the interaction that can have with inquiries and making the tax return as robust as possible. And then just a final refresher on some of the key deadlines and just a quick discussion on some of the tax changes up and coming that might affect your tax return clients. So the importance of getting your tax return right. So most of the tax returns we come across in general practice will be relatively straightforward. So you'll get maybe a client who has an own managed business with P60 income and maybe some dividends. Even this type of client we find should get the exact same attention to detail as some of our maybe wealthier entrepreneurial clients with more investments, more complex matters. Our role in tax compliance isn't just to simply input some data into a tax return, but just to go beyond those easy steps, take a step back and look at our client's position in a holistic view. So clients will come to us because they want peace of mind and they have an expectation for us to catch things that they might overlook. This could mean spotting an opportunity to claim relief that they're not aware of, or flagging something that might trigger some HMRC scrutiny and ensuring that you're managing that risk. So getting the tax return right isn't just about compliance, but it's also about building the trust with the client and the reputation of your firm as well. So even the small oversights can lead to potential corrections by HMRC, so it's making sure that you're managing the risk of those smaller oversights as well and that you're aware of them. So let's just talk about how we can make sure we've got the right facts before we even start the tax return itself. So this is where the role of fact finding comes in. So how do we get the tax return right? Well, it starts much sooner, even before you open the tax software. Fact finding is where the foundations are laid, and too often this step can be rushed. or perhaps assumptions can be made. For example, if you've got clients that you have on an annual basis, generally the circumstances don't change that much. It can be easy just to make an assumption that, you might ask them, what are your circumstances this year? And they'll just say, oh, it's the same. And the reality is, however, clients I find rarely volunteer tax-related information unless they're prompted to do so. So they might not know that, for example, they've started a new side hustle during the year. I know that's quite a popular topic at the minute. And they might just start falling within those reporting thresholds. Or another example, they've started swapping crypto tokens, but maybe because they've not taken out the fiat, which is essentially GBP, out of their account, they might not think it's a taxable event. And if we weren't asked to ask those questions, we wouldn't know. A few more examples. Let's say a client's wage increases to £150,000. They'll need to file a tax return for that year. But for example, if they're not aware of that and we're not asking the question, then they're not to know about that. So we need to be making sure they're asking those sorts of questions. Another example, maybe contributing to a personal pension. Let's say if they're a high rate taxpayer, and they need to claim the relief on the return. Another quite common example of something that might happen and might get missed. Or for example, we've had a client before who is casually mentioned, oh, I sold a property 6 months ago, and they've missed the 60-day deadline because they weren't aware about that because they only thought it was relevant for their year-end return. So again, that can come in a bit earlier than usual. So it's making sure that you're having those ongoing conversations with the client and making sure that they know to let you know about any change of circumstances and that sort of thing. So these aren't rare scenarios, but you can only really find them if you're making sure you're asking the right questions. So that's why a good fact-finding process, whether it's something like a pre-engagement checklist, having a structured call with the client, can be quite essential. You're reducing the risk, you ensure you're showing reasonable care to the client, and then you can also maybe help identify some tax-saving opportunities for them. So when we talk about attention to detail, this is where it really starts. And we find it is better to be proactive and start having those conversations earlier rather than later, so you're ahead of the game. Last point, there is ultimately nothing wrong with seeking a second opinion on any grey areas, particularly where it can get more complex. So we talked about the value of fact finding. Now, I want to touch on some of the more common pitfalls that you might see in practice when preparing tax returns. So this is where attention to detail can play quite a crucial role. Now, these are the kind of, I guess, mistakes or small errors that can easily be avoided, but only if we take the time to ask the right questions and make the relevant checks. So the first thing I would say is the HMRC online account. Now, this is something quite simple, but it often can be overlooked. There is a surprising amount of useful information available on a client's HMRC portal. So, for example, if there's a student loan deduction, or how is their HMRC balance going to affect the payments that are due? Have there been any adjustments to tax to collect tax for future tax years? There's these small administrative things, but it is good practice to get into the habit of checking those items when you're preparing the returns and maybe having a checklist just to check them off. Again, it would just be a shame if a client had overpaid or underpaid, just for the sake of checking one small check on the account. So I feel like it's important to make those checks, and it's just that added value there as well. Next is pension contributions. Now, a situation can arise where a client hasn't claimed higher rate relief, for example, on their contributions because they didn't know they had to include it. Or one thing I find quite common is they've had, say, large employer contributions and they've not realised that it's actually gone above their annual allowance for the year, especially if something like a tapered allowance applies. A great example of this is we did have a new client who approached us to help prepare their returns. And it was initially seemed to be quite a straightforward return, but just as part of that initial conversation that we had with them, doing our fact finding, it actually came to light that they needed to pay the pension tax charge for some previous years, because they hadn't been considering their annual allowances. It's just not something that they'd thought of at the time. So just after digging into the numbers, it had become clear they'd exceeded the allowance. And this just hadn't been picked up in previous years, basically. So we could help them by carrying out that remedial work by making a disclosure to HMRC. And the client was really grateful. We had resolved the issue for them, but mainly because we'd identified it, and it was an issue that they hadn't been aware of previously. So even though we were looking at the current tax year, we'd also asked the right questions and actually identified a historic issue that we could fix for them. So that was a really nice client experience. So I guess it just comes down to having the full picture before you even start drafting the return, because you never know what opportunities or problem solving you can make just by having those conversations. So a next point, now this is quite a hot topic as well, is cryptocurrency. Now, more and more clients I'm finding are dabbling in cryptocurrency, and there are some misconceptions. So I think there was a stat by the FCA, it was about 12% of adults hold some kind of crypto asset now in the UK. And that number is only going to go up the more knowledge that we find about it. And a lot of them, well, not a lot of them, but I found a few of them have this misconception that it is only when they withdraw money from their crypto wallet or their Coinbase account that is the event in which they need to report to HMRC, which it isn't the case. It's They may think they've only withdrawn £200 in GBP, so they don't have to report anything. However, in getting to that point, they've still got a lot of crypto they hold in their wallet. And in getting that crypto, they've made quite a few disposals, swaps for one token to another. For example, Bitcoin to Ethereum, that sort of thing. So it's those crypto to crypto transactions which can trigger those disposals for CGT. However, because they've not withdrawn the money, it doesn't always click in their head that that may be something that's relevant. HMRC is also clamping down on this quite quickly. They're getting data directly from some of the platforms, and have been starting to send out nudge letters to clients who they suspect are failing to disclose. So this isn't something we can really ignore. We do need to be on the front foot about it, and deal with it proactively before HMRC comes knocking. So it's just having the knowledge that, oh, one of your clients might have said, oh, I've invested some crypto this year, and it's just having those follow-up questions to make sure that they're in the accurate position, basically. Just to cover some CGT reliefs, there can be missed opportunities there. It's just about having that technical knowledge. For example, a client may mention a sale after the year end, and by then the 60-day CGT reporting window might have passed. Beyond deadlines, the reliefs themselves could be overlooked or misunderstood. So you've got lots of reliefs like EIS relief, business asset disposal relief, rollover relief, gift relief, the usual kind of reliefs that come into play. It's just about having them in your head and identifying where there's been a disposal, what release could unravel from that and what could follow from that. And then there's private residence relief, which is another classic example. Clients may assume it applies just because it's their house, without having an understanding of some of the periods of occupation, and the nomination rules. And without asking those questions, incorrect claims can be made, or worse, they can be missed entirely because they may assume that, oh, the relief will apply, it's my home, it'll be fine, which isn't always the case. So I guess this is where having that strong tax technical knowledge can combine with a good fact-finding process. It's not just about identifying that a gain exists, but it's about asking the questions, could there be a relief? Do they make the conditions for the relief? Should we be making an election? And also, are we within the time window for the election? These are the questions that can turn a basic tax return into quite a good tax saving opportunity for the client. So it's just about having that knowledge, really. Some other minor points I find it's worth flagging. So things like gift aid donations, which could go unclaimed, even if a small donation of £100, it's a small saving, but it's just that additional question, that additional value that you're bringing to the client. I feel like any kind of small tax saving is still going to be valuable. Child benefit clawback, again, where say a husband may receive the payments, but you're doing the wife's tax return, she might not think it's relevant to mention that. And it's just about asking that question, essentially. Another one I find slips through the cracks, it's not something I come across often. However, it's to do with interest paid on qualifying loans. So let's say, for example, you have a client who wants to invest in a partnership or purchase some shares in a company. If they take out a loan to fund that investment and they pay interest on that loan, there may be a chance that they can claim that interest as a deduction from their tax bill. But that's only if it's picked up and included correctly. So how you get to that conversation with the client, it's just talking about the circumstances. What are their objectives for the year or within the long term, maybe, and just unraveling those sorts of things that may come to light. So these are just kind of the small but impactful details that can be easily missed without having the full picture. Just checking timing wise. Okay, we're fine. Let's have a look. Okay, so I'm just going to run through a couple of examples, bring everything together, and just talk through 2 real-life case studies that we have handled at ETC, which I believe can show the value of having a thorough fact-finding process and the level of complexity that can arise, even if the client believes, oh, it's a fairly standard return, I've got income, a few investments, and I've made some pensions. And actually, what can unravel from that can be quite complicated. So this particular client at case study 1, they had come to us with various income sources, so UK salary, interest, dividends, but also from both UK and foreign investments too. So they also made some historic claims for relief, which we'll come into in a second. So they had the UK and foreign savings and dividend income. They had held some jointly with their spouse and some solely. So what we had to do is make sure that we had apportioned the income correctly and ensured that any foreign tax credits were applied correctly as well. They also had made some significant EIS and venture capital trust investments during the year. Now, for context, you can claim an income tax reducer at a certain percentage of the values invested. I think off the top of my head, I believe it's 30%. However, during this tax year, the tax liability was actually lower than the amounts that they had invested. So we had to carefully decide on the most appropriate order for claiming the reliefs to maximise the saving available in both of the claims. In this case, the EIS relief was able to be carried back to the previous year, which was better because that meant that we could then utilise more of the venture capital trust relief in the current year, which couldn't be carried back or carried forward. So it was making that decision and ensuring that we were utilising we were maximising the relief available. So there was a small portion of relief that couldn't be used, but in any circumstance that we did the relief, there was no way of kind of ensuring that could be used in that sense. So we did maximise it where it was available. So more basic point, relief for pension contributions made in the year. It was just important to gross these up correctly and apply them to extend the basic rate band and ensure accurate savings at higher rates. Now, for the more meaty, I'd say the meaty part, is the capital gains tax considerations. There was quite a lot of moving variables with this. So they'd made 2 disposals within the year. Now, the first disposal was of a US-based company. Now, this disposal had resulted in a £100,000 capital loss. However, some of the consideration had not physically been received yet by the client. So the remainder of which was ascertainable, but it was at risk of being lost. Therefore, we had to think, okay, well, what are the relevant tax rules for deferred consideration? We also added a white space note, a white space disclosure, sorry, that I'll cover later, to explain that position transparently to HMRC. And we also had to bear in mind that if the client didn't receive those proceeds at a later date, there would be a future adjustment that would need to be made as well. So it's also ensuring that after the tax return is done, we're having those ongoing checks with the client to make sure that there is no future implications as well. The second investment, I'm going to call them Tech Co. They were a previously qualifying EIS company. So he had made an investment in this company previously, and now that company within the 3 years had gone bust. Now, this triggered quite a few considerations for us. Now, the first consideration was having to make a negligible value claim to make that capital loss. Then we had to consider what do we do with the loss? There's lots of different options available, and one loss relief that I believe can be a bit overlooked or something that you don't come across on a day-to-day basis actually is utilising that capital loss against total income for the year. Now that's under section 131. I believe it's the Income Tax Act. I'd have to refresh my memory on that. However, using the capital loss against total income, you are saving at higher rates of tax compared to lower CGT rates. So that was a good beneficial outcome for the client. As it was an EIS company, it went bust within the 3 years, hence there was a disposal within the 3 years. We had to still consider then whether there'd be a clawback of the original income tax reducer that he had made. And also, as a final point, he had essentially deferred another capital gain previously by claiming EIS reinvestment relief, which meant the deferred gain had to be reintroduced into this year due to an earlier disposal of the EIS shares. So all in all, the tax return involved quite a lot of moving parts, UK income, foreign income, quite a few reliefs to consider, some loss planning there, a check of previous clawbacks of reliefs, and also bringing in a future a deferred gain as well. And then also ensuring that we had the appropriate white space disclosures to cover all bases on that point. So I think that case just really demonstrates how just a tax return can quickly become quite a complex compliance exercise, and why having that attention to detail, the knowledge of the reliefs, clear communication with the client, and a structured fact-finding process can really be absolutely key into making sure that the return is correct and accurate. Just a quick one on case study 2. So our client rented out a UK property and they'd sold another property during the year. They dabbled in some cryptocurrency. They'd also spent a significant amount of time abroad. So there were a few more moving parts there. So just to quickly skim over this one really. So we had to review the eligibility for private residence relief, verify any occupation periods, prepare and submit the CGT return within the 60-day reporting period. We also had to consolidate and verify any rental income and expenses, do the usual checks of what's allowable, that sort of thing. So that was the more basic part. We then had to look at the cryptocurrency activity, ensure all the reporting there was accurate. So this included looking at a crypto tax software, which enabled us to do section the pooling rules and correctly classify and capture all the transactions there. And then the final part of it was just applying the statutory residence test just to ensure that the client's tax residency was correct and determining what UK income and gains were reportable. So what looked like a fairly routine return at first glance did quickly reveal a few layers of complexity by having those conversations about his movements during the year, what activity he had done in investments, and that sort of thing. So just to quickly talk about the power of white space disclosures. So I had touched on this previously when we had looked at these 2 cases, and we felt it was quite important to have clear communication with HMRC. So they don't just call for having careful calculations, they just call for enough information to HMRC just so we're future-proofing the client's tax returns in the best way that we can. So the question is really, are we doing everything we can to ensure the return is complete and accurate? Especially if there is something quite contentious or a transaction in the year has taken place, I always find it's beneficial to highlight that. So that's where a white space disclosure can be quite helpful. I don't think you don't need it for every single entry for the more basic points. But I do feel strongly about providing HMRC with an explanation as to why we've included something in particular, or maybe why you've not included something in particular. So sometimes you'll find that a client might ask, well, why point out something to HMRC if we don't need to? My response to this is it will help in the long run if they do come across some information at a later date, as it does limit the amount of time they'd have to inquire. So, for example, by not providing sufficient information or taking reasonable care, there is more risk HMRC can make a discovery after the inquiry deadline has passed. So it's finding that balance between giving enough information but not sparking any concerns. So by making the disclosure, you're at least protecting that event from happening. You're demonstrating the client is following the advice of a professional advisor and just giving enough information to HMRC to pick up on within the normal inquiry deadlines. Just a quick outlook on some of the key deadlines that we've got at the minute. So 31st of July 2025, we've got that second payment on account due for 24-25. Usual registration deadlines, submission deadline for paper returns. You don't see that very often now. I have one client who does it by paper. And then the usual, again, 31st of January, the submission deadline for online returns, and then the balance and payment. And then it's, again, just keeping track of those deadlines for the payments on account as well. We always start to send reminders for the payments on account and just double check on the HMRC online system throughout the list of our clients who may have a payment due. So that's there if you want to take a screenshot. But again, these are the more basic points, it's just keeping it aware. And that should say 31st of January 26. My mistake. Even the smaller things. So just to touch on some of the upcoming changes we should prepare for. So currently, you need to send a tax return if you earned more than £1,000 per year in self-employment income or miscellaneous income. So that includes matters for those operating side hustles, so content creation, which is quite trendy, reselling clothes on Vinted, that sort of thing. There is talk about this increasing to £3,000 per year. And this is estimated to exclude about 300,000 people from having to file self-assessment. However, this does not change the trade-in allowance of £1,000. So it might mean that there is some people who still need to pay the tax due, but they don't need to submit self-assessment. So I believe the HMRC are starting to bring in a simple assessment for that, but we're still waiting to hear information. So that's not confirmed at the moment, but that is something that might be on the horizon. So with effect from the 5th of April 25, so that has just come, so it'll be relevant for tax returns for 25-26. This is relevant for, there's some mandatory reporting for traders and close company directors, just administrative things. So it's mandatory to disclose and provide specific information in relation to the shareholding for the close company directors. And those who start and cease to trade, it's now mandatory to report the date of commencement and cessation. Just little bits like that, really, just being aware of them. Rates of CGT, just a reminder of the increases, really. I'm sure everybody's kind of aware of this, but it's worth just going through. Obviously, we had the immediate increase at the autumn budget on the 30th of October 24. Standard CGT rates from 10% 20% and then 18% 24%. 6th of April 2025, that has just come, we had the increase in business asset disposal relief and investors relief rates from 10% to 14%, and then that again next year from the 6th of April 26 will rise to 18%. So it's worthwhile thinking about any clients who may want to dispose of their businesses, whether it's worthwhile considering a disposal prior to that date, if possible. Now, I'm just getting conscious of time, so we'll try and get through this quite quickly. So making tax digital, I did mention I would cover this a little bit, but I do know there are plenty of resources and webinars out there in regards to MTD, so I won't go into too much depth. It is representing one of the biggest shifts in the way that self-employed individuals and landlords report to HMRC. So you've got April 2026. That's when it's going to come into effect properly for those who have revenue over £50,000. And this is not after expenses, this is before expenses. So for those individuals, they will need to keep digital records and submit quarterly updates of their income and expenses. So they'll need to have compatible software that will be able to do that. And that will then, the threshold will decrease to £30,000 from April 27 and then £20,000 from April 28. So it's just time to really consider which of your clients might be affected and start making those important decisions as to what your clients and your practice can do to prepare for that. I believe the first quarterly update is on the 7th of August 26. And there is a testing phase which you can offer to your clients prior to then, just to get prepared for that. So just a quick one. So don't miss out on the next free webinar. This will be presented by Amy, who is one of my colleagues, really good at residence and domicile matters, and she'll be doing it on the end of the remittance basis and other issues for non-doms. So that, just a note on that. So just to wrap up everything we've covered, appreciate it's a bit of a shorter webinar today, but it's simple oversights like maybe missing a pay-as-you-earn adjustment or far more complex matters like crypto disposals. The key theme here is having that attention to detail, having that proactive fact-finding, and just generally having a holistic approach to the client's full picture as to what can transfer maybe a basic tax return into a fully managed compliance outcome and potentially some tax savings there for the client. This is essentially what we aim for as a specialist tax firm. And if anyone did want to have a discussion about what we do and how we can help you and your clients, whether it's just having a second opinion or maybe a more involved collaboration, please don't hesitate to get in touch. So just wanted to say thank you very much for listening. And if we've got time for questions, maybe 1 or 2 questions might be okay. Just conscious of time at the minute, and then I'll open the floor.
Oh, thanks, Olivia. That was brilliant. Yeah, I've got a couple of questions in that we'll just ask you now. What measures can we put into place to ensure we are gathering all the information we need?
Okay, so I think I did touch on this before. I guess it's incorporating things such as checklists. So that's a great starting point. So what we do at ETC is we have a client questionnaire which cover all these matters, and that questionnaire has been built up over the years with new knowledge that has come in. We start off with that questionnaire. We also book in calls with the client. We have annual check-in calls just to make sure we're clear on their circumstances. But I appreciate with maybe a larger accountancy firm, it's not always possible to have those conversations year in, year out if you have quite a large client base. But it's, I guess, having that communication consistently with the client is definitely key there. So I guess that's it really. It's just having those checklists when preparing the returns, but also maybe having the questionnaire. Just a link and mix of those matters, I would say, is probably the best thing for that.
We've got a crypto question also. How do I know if crypto reporting is accurate when reporting on a tax software?
So this can get quite complex because crypto tax software, it doesn't always clean up the data and present it in the best way. They certainly try to be as accurate as possible. Without naming names, there can be some tax softwares we have come across which classify certain transactions as taxable as the default. That might not always be the case. So, for example, I think there's sometimes it can show a transaction as representing a movement of funds from one wallet to another. However, it's marking it as a disposal, not as a movement of funds. So it's actually triggering a capital gain for the client when that's not the case. Ultimately, if there are thousands of transactions from a commercial point of view, unless you're going through every line of data, there's always going to be a bit of a grey area as to what is accurate. What we offer as a firm is we do review the data, check any red flags, maybe those larger transactions, just looking at things like missing costs, uncategorized transactions, anything that screams out to you. And again, this is where we think a white space disclosure can be absolutely key. It's just informing HMRC that reasonable efforts have been made and just checking as many transactions as you can. We tend to find that the clients do need to cooperate with you on that as well, because you don't always have the background as to what certain transactions are. So again, having that communication, just making sure it's as accurate as possible.
And finally, how do I know how much or how little to put into a white space disclosure?
Um, the goal, it's about striking a balance, really. It's just about being transparent enough, but not so much that it's raising unnecessary red flags. I would say that if it is a grey area or a judgment call you're making, or perhaps maybe there's unusual circumstances, a disclosure should always be considered there. You don't want to over-explain, but you also don't want to be too vague. You're clearly stating what's been done, why it's been done, and I think referencing any relevant legislation, guidance, that sort of thing. I guess that's all I can really say, really. I think if it's a specific situation that you're talking about and that you're really not sure on, it's maybe worth getting a second opinion. I'd be happy to have a look if you do have a circumstance where that might arise and be able to help.
Thanks, Olivia, and thanks everyone for joining us. And we will be sending out the slides and recordings within the next week. And if you do have any further questions, please do drop us an email or inquiries at etctax.co.uk. Thank you very much.
Thank you, everybody.